Welcome. You're watching the Mutual Fund Show. I'm Tamanna Inamdar. We're talking about what you should do as a mutual fund investor when markets are at dizzying heights. The Sensex and the Nifty are crossing new life highs every day. The Nifty has now crossed the 24,000 mark for the first time. Now, at a time like this, is it a good opportunity to relook at some of your investments, maybe exit some of your positions, or should you now buffer up? Is this time for a lump sum investment, or what should you really do? We're going to be talking to our panelists on this today because this is the time when you need a very clear-eyed view. Now, speaking on this is InvestAajForKal's Anant Ladha and Rupee With Rushabh's Rushabh Desai. Welcome to both of you. And thank you so much for speaking with us today. Let me come to you first, Anant, on this point that, markets at new highs is great. Everyone's very excited. But at the end of the day, and here I'm just playing devil's advocate, people look at their portfolios and they see that perhaps they're not seeing the same kind of gains as they would have if they had put in money in a Nifty ETF or just bought an index fund. Let's start with that. At a time like this, when markets and especially key indices are crossing new highs, new levels, does the good old index fund or ETF become your best bet?
See, firstly, I know a lot of investors are scared right now. Before I answer a question, I have just gathered a beautiful data which will help a lot of investors. In 2023, we had 27 lifetime highs. In 2022, we had 6. 2021, we had 54. 2020, we had 25. 2019, we had 13 new lifetime highs. On average, in last 5 years, we had 25 lifetime highs every year. If we talk about mothers of all bull runs, which was from 2004 to 2007, we had in all 150 lifetime highs in just 3 years. So if you are scared about lifetime highs and getting worried about your portfolio and thinking about redeeming it, think twice. Now, if you talk about the market, see, last few days, Nifty has done beautifully well, but broader market has underperformed. That is why a lot of investors are feeling that their portfolios have not risen vis-a-vis the Nifty, and it's absolutely okay. I still know when in April and May, Nifty was not moving much, but your portfolio was giving you superb returns. So it is part and parcel of the game. I feel a mix of mutual funds plus index funds plus stock-specific portfolios, if you know how to invest in direct equities, will make more sense on any given point of time.
Okay. What should be the proportion of index funds?
See, I feel for an aggressive investors, 10 to 15% is more than enough. For a very defensive investors, maybe he can go up to 20 to 25%. In India, I still feel there is a lot of scope in active mutual funds, especially in mid-cap, small-cap and multi-cap segments. So that is where you should use expertise of fund managers and be more focused towards active funds.
Okay, Rushabh, let me come to you on this point of where do you go from here? And to the point that investors, I'm not saying they're nervous, but they're wondering how much more is it time to sort of cash out to some extent, and the question about index funds versus actively managed funds.
Manna, first of all, thanks so much for having me on the show. I agree what Anand had to say, that just because we are at a lifetime high, that doesn't mean you have to be scared and worried. See, let's look at the underlying facts of the market, which is the valuation segment, right? See, today, large caps are quite reasonably priced vis-a the mid and small caps. Large caps are trading close to their long-term average. So large caps is very reasonably priced today. See, I feel this is just a start for the large cap segment. I still feel there is a lot of upside opportunity and upside room in the large cap, which is the Nifty and the Sensex. Okay. Now, if you compare this with the mid and small caps are trading at a very high premium. See, I won't say that mid and small caps won't rally from this point, but it is, better to be little cautious today in the mid and small cap segments. Having said that, investors should stick with, their goal, their time horizon, risk appetite, and asset allocation. At this point of time, if you ask me personally, I wouldn't put in lump sum money, or I wouldn't be comfortable putting in fresh lump sum money in the mid and small cap space. But large cap space is something I'm very, very comfortable to deploy my money, because I see a lot of upside opportunity from this point of time over the next 2 to 3 years. This is number one. Number two, coming to your index fund question. See, index funds, I'm currently recommending in the large cap space because active large cap funds have unfortunately underperformed quite significantly compared to their benchmarks because the universe is also limited for the large cap fund managers to play around. It's just top 100 stocks they can play around with. So I feel going into a traditional index fund in the large cap segment or a smart beta large cap fund would work best. But as Anant said that, I completely agree with him that I see a lot of uh, opportunity in the active mid and small cap segments, which is, whether it is mid cap, small caps or flexi cap, multi caps, etc.
Um, all right. What would you say to the question of if you've seen a big run up in your small and mid cap funds? And we will be taking your queries, viewers. Those numbers on your screen, if you have any queries to send in to us, please do. But just posing a few myself, Rushabh, what would you say to the question of if I've seen a phenomenal run up in small and mid cap funds, which has been the case in many of those funds, if I'm sitting on those profits, is it time for me to rotate out and reinvest in a large cap fund?
See, Tamana, there are two ways to look at this. One is that if your goal is coming near in the next 6 months to 1 year, then this is a great time to book profits, okay, and venture into fixed income from a safety point of view. Second, see, if my mid and small cap portfolio has rallied significantly, say if my mid and small cap exposure or original decided allocation was somewhere around 40 to 50%, and if the exposure has jumped up significantly to around 65-70%, then this is a very good time to rebalance and trim down the risk from the mid and small cap space. So number one, if your goal is coming near, this is a good time to book profits. Number two, this is a very good time to rebalance in the mid and small cap space if the mid and small caps allocation have rallied quite significantly.
Okay, I'm going to take that question to Anant as well. It's time for a relook at the portfolio, a rebalancing.
See, looking at your portfolio on annual basis is always useful, and you should look at your asset allocation according to your risk profile. Supposedly, if today you are overexposed in small cap and mid cap and you want to book profit, I would suggest a different strategy. We always talk about SIPs in stock markets. In the same way, you can withdraw your money every month or maybe every week, slowly and gradually, because right now we are seeing strong momentum in small cap and mid cap, and we never know how much more there is juice available in the same space. So instead of having FOMO and taking some wrong decision, you can probably take out your money, follow your risk allocation, profile allocation, and take out your money in probably next 10 months gradually, and you will be better off in your portfolio.
Okay. Now, the other big question is that now that we've seen this massive run up in equity, is it time to also look at debt and scale up your debt outlook? And I'm also asking this ahead of, the inclusion of Indian bonds in the JPM index. That bond inclusion is also going to push a lot of money into the market. And there's a whole host of factors, really. Now, the rate cut cycle will begin sooner or later. It's a question of when, not if. Let me come to Rushabh with that question first, on whether it's time to relook and increase allocation to debt.
Tamanna, see, I feel we are in a golden period for the debt segment. There are a couple of reasons why. See, currently we are at the peak in the interest rate cycle. AAA bond yields are trading between 7-8%. Number two, as you correctly pointed out, that India has come in the JP Morgan's emerging bond index, and from Jan 2025, India will also come in the Bloomberg emerging bond index. So this will give a huge demand, or this will boost the demand for Indian bonds globally. So I feel over the next 2 years, around 20 to 40 billion dollars will come in the Indian bonds, which will, hike the price from the mark-to-market level, right? And see, inflation today is very much under control, right? So we feel probably from this year end or early next year, RBI should begin the interest rate cut cycle. That will also benefit immensely at the mark-to-market level. The debt products will benefit immensely from these factors. So I feel today is a very good time for investors who have a 2 to 3 year time horizon to look at medium to long duration debt products.
Okay. Rushabh, are you, you were saying you're excited about debt. Anant, what about you? Are you also constructive on debt right now or in terms of
See,
fund allocations?
I totally agree with Rushabh's point of view that debt is attractive right now. But at the same time, I would like to present a complete picture. Yesterday, only one of the committee member of Fed presented a very different view. She was of the opinion that presently inflation in US markets are ranging around 2.6% versus their target of 2%. And she was talking about rate hikes. It was shocking to me, and I am very sure it was shocking for a lot of people that in present scenario, if we talk about rate hike, but that is one thing which you have to just take it with a pinch of salt, that you can see some volatility for next 6 months in debt market as well. If we talk about history, it has been history of US markets that whenever election are nearby, just before the election, they come up with a random reason and a random rate cut. Will it happen this time also? I am not sure. But if that happens, I think everyone will be happy with it. But looking at everything from next 6 months perspective, I feel it will be a very good time to pump in your money in debt market with 2 to 3 years of time horizon and duration of roughly 4 to 5 years at max.
Okay, so pump in money in the debt market. Now, before we take a break and get to all of our queries, I'm going to ask both of you about your top funds to allocate at this point. Rushabh, you've already said that you're leaning towards the large cap funds versus the mid and small. You are positive on debt as well. So if there is someone looking to make an investment right now, if not a lump sum or at least bump up their allocations on SIPs, what would be your top 3 choices or top 4 choices right now?
Tamanna, for SIP, you can always venture in the mid and small cap space because you're spreading out your investments over a longer period of time. So for SIPs, just stick with your asset allocation and you'll be very well sorted. You don't need to, choose large caps because mid and small caps are trading at a premium today. This is specifically for lump sum. If someone wants to make fresh allocation as a lump sum, then I would bet on large caps rather than mid and small caps today. So I see 3 opportunity pockets in the equity segment. One is the large cap space, which is reasonably priced versus mid and small caps. Number 2, growth strategy products, because growth has underperformed over the past 3.5 years compared to value. So I feel, that growth strategy will come back in action in the next 3 years or so. And third is the dynamic asset allocation category, which is also known as balance advantage funds. I see immense opportunity in these 3 pockets in the equity segment. Coming to the debt space, as I mentioned that, I see opportunity in medium to long duration bonds. But overall, if you see the yield curve from the shorter duration to the longer duration is more or less flat. So I see the sweet spot opportunity lies in like 4 to 7 year maturity bucket. So around major allocation has to be given in corporate bond funds and banking PSU funds, and around 30% tactical allocation can be given in long duration GSET funds.
Okay, Anand, what would be your top list?
See, if you're looking for some technical calls, I feel IT and banking segment is 2 segments which have largely underperformed in last 2 years. So if an aggressive investor is looking out to make some allocations in tactical funds, these 2 can be tactical allocations. Other than that, I am in line with Rushabh's view of doing SIPs in small and mid cap funds, especially if you are ready for some underperformance in next 3 years. See, when you start an SIP, your purpose is to accumulate units, not to see MTM profit, because any which ways you won't be booking it for next few years. You want to see how many units you can collect in market volatility. If we talk about volatility, right now, small cap and mid cap seems to be comparatively overvalued. So you will see more of volatility in that segment. And if you are a long-term investor and you will stick to your words when there are some volatile markets, then yes, small and mid cap segment is still a beautiful segment to start off. If you are a very defensive investor but want some exposure in small and mid caps, multi cap is as a category is one of my favorite category which you can look at. If you talk about debt funds, I feel all season bond funds can be an interesting play. Secondly, even medium term funds are having decent duration of 4 to 5 years with YTMs of almost touching 8%. Those can be interesting areas to invest.
Okay, so these are some of their top funds, but what is the right advice for you? We're taking a very short break and coming back with that. Stay tuned for more. Welcome back. You're watching the Mutual Fund Show. Now, it's that time of the show where we take your queries. Our first question is from Ravneet, aged 29, and Ravneet wants views on the Motilal Oswal Mid Cap Fund. Says, I'm investing 4,000 rupees per month and I have a long-term investment horizon. So, it's a specific query on this particular fund. Rushabh, why don't you field this first?
Tamanna, it's a great fund, Motilal Oswal Midcap Fund, backed by a very good management, and the AMC is also recently revamped. The senior leadership team in the AMC. So I see a lot of opportunity for the fund to grow from this point of time. If he has only one fund in his portfolio, I would suggest to diversify a little bit. Concentrating just in the mid cap space, will bring a lot of cyclicality and volatility. So probably a little bit of large cap exposure would balance it out. But otherwise, the fund is very good. Continue to invest the way it is. Keep a longer time horizon. I feel that the fund will do great.
Okay, so keep it for a longer time horizon. Also look at possibly diversifying. Asif has set us his next query. He's 36 and says, I'm investing 10,000 rupees per month in 5 funds. Should I diversify further? He's also given his current investments: Nippon Large Cap Fund, ICICI Prudential Technology Fund, Motilal Oswal Mid Cap Fund, Franklin Smaller Companies Fund, and a UTI Nifty 50 Index Fund. Seems like a good mix, Anant. The question is, should he diversify further? Maybe add a debt fund here. What would you say?
See, if he's talking about equity, I feel he has a good mix of portfolio and there is no need of over diversification. We are investors and we are not collectors of funds. We don't need to collect a lot of funds. Presently, his allocation is decent. He just need to take care of his debt allocation. I am sure he's doing some FDs or maybe PPF for his debt allocation. If not, then he can allocate some money in all season bond funds, which can be invested with 4 to 5 years time horizon in mind. And he should ensure that he's following his risk profile for debt to equity allocation. I know presently everyone is running after equities, but in long term, having a proper asset allocation will always bring maybe more suitability, will be more suitable for you, especially in case of volatile scenarios.
No, so let me just do a follow up on that, Anant. You talked about PPF. A lot of people have PF, depending, on what their structure is. When you're looking at your entire portfolio and looking at whether you have a decent enough debt allocation, important to take your PF into account as well?
100%. It's a very good traditional debt product. And if you're investing in PF, I'll count it in your debt portfolio.
Rushabh, just want to get your take on that as well, and also the query of this viewer, of Asif's. Should he diversify further from these 5 funds, replace any, and the debt perspective?
Tamanna, overall, the portfolio is very well balanced and very well diversified. So I really don't see a need to accumulate more funds in the portfolio. We always tell our clients, to keep your funds anywhere between 5 to 6. Don't go more than 6 funds in your core portfolio. The only change what I would like to recommend is that, rather than going into ICICI Technology Fund, I would like to replace that fund and go for Parak Flexi Cap Fund. There are 2 specific reasons for that. One is that, see, ICICI Technology Fund is a sectorial fund, and sectorial bets can be very cyclical and volatile. They require precise entry and exit, to make optimum returns. So SIP methodology may not work well for this particular product. Instead, if he goes for Parak Flexi Cap Fund, does invest in technology companies, and the technology companies which are based in US and which have global presence. So I feel that replacing ICICI Prudential Technology Fund with Parak Flexi Cap would be a better bet.
Okay, so those are some of your options. Pragyan has the next query, is 45, and says, what are some of the best large cap funds that can work well in the long run? Now, we sort of addressed that question, but I will pose it again. Let me come to Anant this time for it first. Some of the best large cap funds, and if you get into a large cap fund at this point, Anant, would you say a lump sum is a better idea or a SIP?
See, SIPs in large caps are always a good idea to do. Lump sum, probably you can wait for dips and be ready to utilize them. If you want to keep just large cap fund, let's keep it simple. You can directly use Nifty 50 equal weight index fund, and it will suffice your purpose. Almost all major AMCs provided. You can choose it as per your liking towards any particular AMC. It won't make much of a difference. But Nifty 50 equal weight index fund is probably best choice to invest in large cap funds.
Would you concur with that, Rushabh?
Actually, I would go for the traditional Nifty 50 index fund and the Sensex plan. These are the two products where I feel But as Anant said, that equal weight is also a good product. But this is just my personal choice, that traditional Nifty 50 index funds and Sensex fund, just to keep it little simple. I think, rather than doing an SIP, because the valuations in the large cap segment are quite reasonable at this point of time, if he wants to do a lump sum investment, I would definitely put my money in the large cap space.
Okay, so right now a lump sum investment in large cap makes sense, and maybe if you're looking at mid and small cap, then an SIP. Mizban writes into us, who's 34, they say that I'm looking to invest in a fund of funds to add more foreign exposure to my portfolio. What are some of the best bets? Very interesting question from Mizban. Thank you for that. I mean, we were just reporting how Amazon is now a $3 trillion market cap company, has hit a lifetime high. Everyone's agog with what NVIDIA is doing every second day. Anant, how do you get on to that gravy train?
See, having some international exposure is always good. I know from 2010 to 2020, international markets, specifically US market, have significantly outperformed an Indian markets. That is why everyone is attracted towards international exposure. Having some exposure is okay, but I feel in this decade, emerging markets, specifically India, is tend to outperform. This is my stance from. I still remember we did a show with you guys in 2021. That time also I had a strong opinion that last decade belonged to developed markets, but this decade belonged to Indian markets or maybe emerging markets for that matter. But still, we can have some exposure in international funds. If he's looking out specifically for fund of fund, he can choose ICICI Prudential Global Advantage Fund. If we want to keep it more simpler, he can probably invest in S&P index fund, which will invest in top companies of the world, and is a very simple way to invest in international markets. To name the fund, Motilal has a beautiful S&P index fund.
Okay, so the Motilal S&P index fund is one you can look at. The ICICI Pru also has an option. But Anant, it doesn't have to be an either or, na? I mean, emerging markets, I mean, it is the Indian investor who's pushing up the market. But there's no harm in having an exposure to international markets as well.
Yes, you can surely have it, but having too much of overexposure, I don't feel it makes sense in this decade. Having 10%, 15% or 20% according to your risk profile is absolutely okay.
Okay, how would you look at it, Rushabh?
I agree what Anant had to say. Having a little bit of international exposure is very important. Let's not forget that these companies are global companies, have strong earnings, have strong global presence. We are using a Zoom platform today to communicate with each other. So I feel having one foot in the foreign market, especially the US market, is absolutely very important. Investors can look at investing in Nasdaq 100, S&P 500, or the matter of fact, the Mirai Asset Fang Plus fund of fund is also a great product, I feel. So having around 20 to 30% allocation overseas, especially in the developed markets like the US markets, is absolutely very important.
Okay, so that's the story on foreign exposure in your portfolio. Sakshi Bhatia writes to us, age 27, says, I invest 1 lakh rupees per month in the following instruments. There's a banking debt fund at 30,000 rupees, Aditya Birla Sun Life PSU at 25,000 rupees, Nippon India Small Cap Fund 25,000 rupees, and HDFC Manufacturing Fund at 20,000 rupees. The aim is to buy an Audi Q5 in the next 2 years at 65 to 70 lakh rupees. That's what it's going to cost, or have a good amount to pay as a down payment. After all of that, you want to buy something which will depreciate immediately. But it's your wish, Sakshi. Very good investment portfolio as well. How do you reach that Audi dream, Rushabh?
As you correctly pointed out that, it is a depreciating asset at this point of time. I mean, see, it's a very personal choice. If
But the
you know, I mean,
heart wants what the heart wants. So in this case,
absolutely.
Sakshi wants her Audi Q5. You have to help her get it.
Absolutely, absolutely. But I feel over the next 2 years, it seems little difficult looking at her portfolio. I think she would require a little bit of a longer time horizon, say probably like say 8 or 9 years. I think probably at that point of time, she will be comfortably be able to buy the car with her mutual funds and with her equity portfolio. At this point of time, this is what I would strongly recommend is to clear her down payments, is because that is something this is what something I would do, or I would recommend my clients to do, is clear your down payments. That is because it's based on interest and it's going to charge you interest. So clear your down payment as soon as possible, and then probably she can focus on buying a wonderful Audi.
Okay, so 8 to 9 years. Rushabh is making you wait 8 to 9 years instead of 2 years. So you'll have to think of another way. But thank you so much, Rushabh and Anant, for joining us on this show today. Always a pleasure to speak with both of you. That's all the time we have on the Mutual Fund Show. Numbers on our screen where you can reach out to us with your queries. But for now, we'll have to leave it there. Stay tuned though, a lot more coming up on the other side on NDTV Profit.